when we are looking at the different time frames, we're also looking at different views of risk. A 15-minute chart usually is going to entail less risk than a daily. And the most simple way to explain the why of this is, if given 15 minutes, how much ground can you cover? If you're going to walk for the next 15 minutes, how much ground can you cover? Versus if I said, hey, walk for the next 24 hours, are you going to cover more ground? The trading day is just like that. Okay? So the first determination, the first decision we make about risk, I think comes down to our time frames. Daily charts, for the most part, generally speaking, are going to be more risky in terms of how much pip movement you're going to have to sit through versus a 15-minute chart or even a 5-minute chart. So the very time frame you choose is going to have a risk aspect to it. Okay? That's not the only reason we choose time frames, but it certainly has got to be a part of that decision process. So let's kind of transition now into the breakdown of the different pairs, and we'll start getting into trading hours and see some more specifics here. This view of all the different pairs, and this is just one of many views we can look at. This view of all the different pairs is showing you how much pip movement we've seen on average throughout one trading session, like every single, one day, for the past 6 months. In other words, so if I have the Aussie US dollar right here, and what this particular graph is showing us, look at this first bar here for the Aussie US dollar, is we see on average we might make a low somewhere near 60 pips per day, a high somewhere near 120 pips per day, and then finally on average about 90 pips per day. Now the average is the band you see, the black band across the green bar. So you have your high pip movement or price movement range, your low, and then your average. And what this is taken from is the common movement we've seen over the past 6 months. I could even focus that down to 1 month. Okay, and notice the difference if I take just the last month of price action. It's still about it's still a fairly small-bodied bar as far as the Aussie is not that volatile as far as its upper range, but look how much less volatile it's been over the past 1 month than the past 6. So we had a range of about 60 to 120 with an average of 90 over the 6 months. Take a look at the last 1 month. Its behavior is much different. The average is about 70. The high is about 90. And the low is almost 50, 55 pips. So the Aussie, just from the last 6 months, this most recent month, has definitely changed its behavior. It's much less volatile right now. How does this help me in terms of risk management? I have a much better idea as to how much the Aussie is going to move. I have a much better idea of the volatility it's seeing on average. Again, it's on average. Are there things that are going to affect whether or not the Aussie moves upwards of 80 pips or closer to 50? Absolutely. What are those events? Certainly scheduled economic events are going to make a difference. If I have some huge economic events affecting the Aussie a particular month or a particular day, that's certainly going to have the potential of making the Aussie move towards its high range of the price or pip movement range. If I don't, that certainly could push it down towards its low. And what about unscheduled events? Not everything's scheduled. Not everything comes nice and neatly packaged at a scheduled time. Certainly unscheduled events are even more volatile than scheduled events. Don't think that we can just gauge the volatility of the market based upon this study and an economic calendar. I think most of the time that is very helpful, but there, of course, are occasions where completely unscheduled events will move a market. All right, so take a look at each one of these pairs. These are the pairs that are scanned by the PowerStats. And a lot of the most popular pairs are here. There might be a crossfade or something that you do trade that isn't listed here, but I wanted to get the idea across that if you take a look at each one of these pairs or cross rates, there's very different mannerisms for each one of them. I am not going to focus on the highest vol. The biggest mistake I see, the most obtuse thing I see is people just running to the highest volatility pair. Hence, for whatever reason, far too many new traders will run over to the pound yen because all they see is the average of over 200, the average of over about 170 pips per day, and sometimes well over 220. They see that and all they think about are dollar signs. You know what I see? I see risk. I see the possibility for high volatility to adversely affect me, because the bottom line is we all have very high reward tolerances, right? None of us are going to go, oh, no, I can't afford to make that much, right? But we all have very definite risk tolerances. So whenever I look at this movement, I'm thinking of it from a risk standpoint. But if things go wrong, they can go horribly wrong very quickly on the pound yen. Now, am I saying you shouldn't trade the pound yen? No, not at all. All I'm saying is if you're going to hop into this race car, know the kind of horsepower you're going to be dealing with. You go Ferrari. Yeah? So that's the way we want to break these down. Now I realize I took two very different pairs in terms of the dramatics, but I want to make a point. Anytime, and this is, I've heard a lot of these fixed pip stops where someone might say, oh, I'm willing to, let the pair move. I'm looking for a risk of, say, 40 pips. And I'm just pulling these numbers out of nowhere. I've heard every kind of combination possible. But say 40 pips, I'll risk, and I'm looking to make 80 pips. Okay? Now, if those two numbers were associated with some sort of support or resistance level, as those two numbers, the 40 pip risk tolerance, the 80 pip expectation for reward, those came with some sort of support and resistance, or some sort of pip movement understanding. In other words, the fact that the pair moves on average that kind of amount. It would make sense. Okay? But even if I had a pair that might have that kind of mannerism during certain hours of the day, it won't be all 24 hours of the day. And certainly something like that is not a one-size-fits-all. I can't apply something like that to every one of these pairs. 40 pips of risk might be a lot for something like the Euro Swissy. That's a ton when the average movement is 40 pips, right? It's not even close to being able to handle the volatility of the pound yen or the cable. Take a look at the cable. So again, for those of you that are thinking about these fixed pips, stop losses, and even profit targets, I just want you to question where that logic comes from. Because what I'm showing you here is every pip had every pair had its own characteristics in terms of pip movement. Now, what if I dissect one of these? Let's take that next step. All right, in our next little, as we segue into taking one of these pairs and breaking it down into that 24-hour dissection I talked about, we'll do that next.